Nicolas Veron, and on behalf of Bruegel, it's my pleasure to introduce this session to discuss a new report fresh off the presses by the European Court of Auditors on control of state aid to financial institutions in the EU in need of a fitness check. So we'll discuss this with a member of the European Court of Auditors who was in charge of this report, thanks to Mihail Kozlovs for joining us. Mihail has a distinguished career in the Latvian Ministry of Finance, including in the run-up to Latvian accession to the EU and also the Latvian presidency. And he's been at the European Court of Auditors for a bit more than 4 years. This is a relatively short session. We will have little time because we wanted to pack as much as possible to not take too much of the time of our audience. And so I'm not saying more in introduction. Mihail, over to you.
Thank you. Thank you very much, Nicola, and thanks for the opportunity to spread the news about this report. Let me start by a quote from one of the former US President, Ronald Reagan, who said, I learn from the past, but I look into the future. So this is what actually guided the European Court of Auditors in its work on this subject. So the main message of the report is that there is a need for a fitness check of both rules on the state aid control to financial institutions and of the implementation of these rules, even despite the uncertainties created by the potential impact of COVID-19. I will now share a couple of slides with the audience so that they could follow, and because I won't be able to tell you everything from the report, I would only concentrate on the main things. So basically, why did we do this audit? To be very concise, we want to give an account to the European taxpayers about the progress towards building a more resilient banking sector in the European Union, so that their money could be invested better in the real economy, in the health sector, also in climate policies, and state aid control activity in line with the treaty certainly plays a role here. The global financial crisis of 2007 to 2008 put financial stability at the forefront of financial policy. This is an interesting point in itself. The objective was to maintain financial stability under the condition that distortions to competition are minimized. That resulted in sizable government interventions of several trillion euros between 2008 and 2011 that were approved by the Commission. And back in time, basically, the recourse to public funds to bail out financial institutions was a kind of a normal practice, and maybe also a needed practice. Yet the political promise at the EU level was very clear: to avoid situations in the future where so much taxpayers' money should go into banks, especially in cases where problems might have been caused to various degrees by internal issues within these institutions, such as excessive risk-taking or management failures. So now, 10 years later, we observe that the EU banking sector remains a significant beneficiary of state aid. And this happens despite a much better economic environment during 2013-2018, and more resilient banking sector, with some caveats, of course, but I think the overall consensus is that the banking sector in that period was more resilient. New regulatory framework, mainly single supervision of banks, bank recovery and resolution, single resolution mechanism, and new institutions to implement the new regulatory framework. In the context of what I said about the general environment, it is important to see if the rules in place are actually optimal to ensure the achievement of the treaty objective. And if the Commission that is responsible for upholding the principles of the treaty on the general prohibition of state aid ensured that that aid was indeed exceptional and limited to the minimum necessary. Of course, the role of the Commission as the controller of state aid cannot be viewed in isolation. The chain leading to state aid is actually very long. Bank management, external auditors, member states deciding to support the bank supervisors, and resolution authorities. So now let me come to our findings and recommendations. As I said, I will focus on the areas where we saw challenges, while in the report there are also various examples of positive practices of the Commission. Let me start from the most important one related to the framework and rules as well as their implementation. The state aid rules have not been reviewed since 2013, despite significant progress in building the banking union. I referred to above, and it cannot be excluded in a way that the two frameworks, basically state aid control framework and BRRD framework, Bank Recovery and Resolution Directive framework, are not really convergent, and there might be certain tensions between them. Besides, in our view, the framework, the rules have certain deficiencies, such as they do not define and they present no criteria for a key concept of serious disturbance and financial stability that should be central in the assessment of a state aid case. They also leave too much room for interpretation by various authorities pursuing sometimes different objectives, although fully in line with their mandate. Similar to the absence of revision of the state aid rules in force, the Commission did not perform any formal evaluation to assess whether the state rules for financial sector had actually worked. So whether they were in line in practice with the objectives of respective article of the EU treaty. Regarding implementation, we identified areas where the Commission's performance could be improved. For example, in both restructuring and liquidation cases, the Commission did not contest the information submitted by member states about the existence of a serious disturbance or the existence of a risk of a serious disturbance in the economy or about a serious threat to financial stability. Therefore, the Commission effectively relied on the submissions of member states, which are in effect interested parties in a particular case. So our first recommendation to the Commission actually covers these points, and I'm actually pleased to tell you that the Commission has acknowledged the need to carry out an evaluation of state aid rules. More specifically, we suggest that such evaluation should cover setting out the criteria for assessment of serious disturbance, specifying the level of detail for information submitted by the member states, and the role of the Commission in assessing this information. Considering the application of common assessment principles for state aid control in the financial sector, and last but not the least, adjusting the conditions for compatibility of precautionary measures and aid in resolution, thus effectively ensuring consistency between the two sets of rules applicable, namely the banking communication of 2013 and Bank Recovery and Resolution Directive. Let me now present our findings and recommendations regarding the processes and the procedures. These might seem of minor relevance individually, but altogether they boil down to such concepts as transparency, the efficiency, the right to public scrutiny. So generally, the Commission is well equipped to ensure efficient handling of state aid cases. For example, in the inter-service consultations, actually all departments of the Commission have a right to put their proposals, their questions, to express their view. And what we found is that actually in our sample, no other Commission department submitted a negative opinion, but there were comments as regards the justification, the reasoning, and the economic assessment of a draft decision, which goes in fact in line with our findings about the level of detail in the assessments. Case handling activities mostly adhere to internal processes, with some room for improvement regarding the registration of all files for a particular case. The state aid procedure were mostly in line with both formal and non-binding guidance of the Commission. Sometimes they were too lengthy. Also, they could have been more transparent. I mean here the extensive use of the pre-notification contacts. And finally, a publication of decisions was often delayed for various reasons, I must say, not always due to the Commission. And based on these findings, we recommend to the Commission to increase efficiency, accountability, and also transparency of its case handling procedures along the following main lines: to improve the document management so that all files, all documents related to a specific case are registered properly in order to meet the requirement for eventual public scrutiny. To encourage member states to base pre-notification contacts on the written draft notifications, and not to exceed 6-month limit for those, which is in line with the Commission's best practice code. The crisis rules on state aid also require to limit distortion to competition that can be achieved by keeping aid, by keeping aid amounts to the minimum necessary. And to achieve this, the Commission and member states and beneficiaries together negotiate the commitments, so-called commitments. And we found that the Commission indeed imposed measures to limit distortions of competitions, but sometimes the calibration of the commitments to the distortive effect of the measure was not always fully explained. The analysis by the Commission of the impact of the measure on competition could be enhanced, and the Commission also did not proactively analyze the alternative and potentially less costly options for granting state aid. Monitoring of the effectiveness of the EU action in the field of state aid control is very important in our view, and performance indicators can help here. We found that the performance indicators developed by the Commissions for this purpose were not entirely fit for this purpose, because they reflected sometimes external factors beyond the control of the Commission, and they also did not always reflect the Commission activities themselves. Therefore, in order to demonstrate the effect of state aid control and to enhance transparency and accountability, we recommend to the Commission to define suitable and relevant indicators for effective performance measurement. So, to sum up, the European Court of Auditors, invited the Commission to perform an in-depth evaluation of state aid rules for banks and engage in a debate with other stakeholders notably the Council and the European Parliament, in order to ensure that the rules are fit for the purpose at any point in time, and that they contribute to wider objectives of the European Union in the field of financial sector. So I will stop here. Nicola, thank you. Thanks to you and for the audience for their attention. And over to you, Nicola.
Thank you. Thanks, Val. That was very succinct and helpful to understand both the intent and the content of the report. We already have questions on Slido. So for those who are not familiar with our platform, you have to go on your web browser to Slido, sli.do, and enter the code state aid in one word, STATEAID. And that's where you can ask questions. Some have already started, so let me go there and take it from there. The first question is, as you mentioned, the current communication was written in 2013. Now we have had some adjustments in the context of COVID-19, but there have been 7 years without a change to that communication, even so market conditions changed enormously and favorably during that 7-year period. How do you explain that the Commission hasn't revised the state aid communication for banks, and what have been the obstacles, including political obstacles, in your judgment?
Thank you. Well, it is difficult to answer the question why the Commission did not perform such kind of assessment. I think that in their replies, because the Commission's replies to the report are also published together with the report, the Commission actually provides some explanations. Some explanations in a way that the crisis was not yet fully over. There were still pockets of instability in various member states. The levels of NPLs in some member states was still relatively high. So this was basically the Commission's line of argumentation. In terms of COVID, I think it's a separate question actually, and we did not look into the COVID context of the whole story. We have a paragraph in the report that refers to the temporary framework of the Commission, which we did not analyze, obviously. But looking forward, I would rather ask a question: if at some stage we arrive at a situation where banks do face, or some of them, or in some countries face serious problems, is the current framework actually fit for the purpose? Yeah. So this is kind of a counter question, because given some of the uncertainties, inconsistencies we have described in the report, there is a risk, or there might be a risk that in case of a massive need for support to a financial sector, the current rules might not work in an optimal way. And also, that's not in the report, it's more my personal view, the resources that were actually available for support of the banking sector in the past might not be available now.
You mean financial resources, or do you mean human resources?
Yes, financial resources that I mentioned that were actually poured in the banking sector in that period of time might not be available now. Yeah.
So when you say the rules may not be the right ones for possible future intervention in the banking sector as a consequence of the COVID-19 crisis, can you be a little bit more specific and tell us what piece of the rules do you think could be put into question there?
Well, that's again, I mean, going a little bit beyond what we did, because then we would need to also look in detail at the Bank Recovery and Resolution Directive.
That's right. I take it as a personal question to you and not a question about the report.
Yes, yes. I think that then, I mean, there would be a need to address the inconsistencies that we identified in the report to some extent, and that are identified also in the kind of in the academic literature quite a lot. I mean, in much more detail than in the report, using specific examples, because these inconsistencies or tensions, they might lead to various risks, I don't know, of unequal treatment, of the support packages not always conducive to the general objectives of the EU in terms of further integration of financial markets in the EU.
So one thing I should have said at the outset, and I simply forgot, is that I have, of course, have absolutely no role in this report, except that I was part of one of the panels that the European Court of Auditors put together in its internal process of preparation. But that doesn't put my fingerprints on the report, metaphorically or literally. I was grateful to be included, by the way. It was an interesting conversation. Yeah, I'll come back to another point, which you mentioned in your presentation, which is the case for an evaluation by the European Commission of their practice of state aid control. Can you give us a little bit color on that process of evaluation, and how does the Commission avoid the inherent risks of evaluating itself, right? I mean, how is the evaluation independent enough to be relevant in this context?
Yeah, well, if you mean the evaluation of the state aid rules themselves, yes.
Yeah, the evaluation that you called for in the report and that the Commission accepted to do.
Yes, I think, well, in the report we mentioned two pieces of assessment, of evaluation that we use, that could be considered as a preliminary review, but first of all, they were not formal. I mean, here and secondly, they took place sometime in the past already. Yeah, so they're in a way outdated. I mean, here the working paper of the Commission of 2011, where the Commission, before banking communication 2013, kind of assessed the functioning of the crisis rules. And secondly, there was also a study commissioned by the European Parliament, again along around the same time. And the conclusions of both, they're slightly contradictory. They are not the same. Well, they shouldn't be the same, but they're quite contradictory, and we show this in the report again. So and now already, for, as you said, also more than 7 years, there is no formal assessment of how the rules actually functioned. And from the court's perspective, we look at the better regulation principles that are applicable across the board. And well, from that perspective, we saw the need for such an evaluation. And as I said, I mean, the Commission has finally acknowledged the need and also committed to perform such an evaluation. Of course, COVID might introduce some dimensions here. On the one hand, it might delay such an evaluation. On the other hand, it might also need such an evaluation and potential improvements more urgent than before. Yeah. So here I can't make any judgment, but there can be these two dimensions.
Right. We have a question on whether the current temporary rules, COVID related on state aid, result in an exemption of precautionary capitalization from burden sharing, and I think the answer to that question is yes. It's paragraph 7 of the temporary rules, right?
Yeah, and I think we have described this in the report. that the fact that the burden sharing requirements are different in the Bank Recovery and Resolution Directive and Banking Communication 2013 is a matter of fact, and it might create, as I said, inconsistencies and
yeah, but my point was about the 2020 rules and precautionary recapitalization, and there is an exemption there in the 2020 temporary framework for state aid control, right? This is not in your report, I think.
You mean the temporary framework?
Yes.
No. Temporary framework is not in our report. But I mean, the temporary framework is relatively clear. Again, it's not in the report, but it's relatively clear that everything that's related to COVID is compatible. Yeah. But we see that the Commission, we didn't analyze, but we see that the Commission still takes a certain amount of decisions under 1073B. And I mean, this again calls for certain questions about this precautionary capitalization. But yeah, we didn't analyze this, so I can't go too much into that.
So there's a question from Maria, which I will rephrase my way, because she says the SRB has clear definitions of disturbance of financial stability. I'm not sure these are clear definitions. They published a paper about that. But let me rephrase the question the following way, which is the SRB came into force in 2016. Has it made a difference? In the cases you have observed, do you see a time before and a time after the SRB, or not really, in terms of the practice of the Commission in those cases?
Well, yeah. First of all, on these differences, clearly the SRB and the Commission. I mean, as I said, there is a risk that the criteria of serious disturbance is interpreted in a different way by the institutions involved in the process. And I think this is exactly part of the problem, especially when it might be perceived that the views that their views on the same point essentially are in a way different. Yeah. So I think from this perspective, this is what we underlined many times, and the Commission also agreed to look into this as part of such assessment, that there is a need to somehow make sure that there is a bit more uniformity in this. And here I always give an example of serious downturn in the economy that is used for the fiscal purposes. And there, these rules are defined in a much more detailed way. And if you look at the amount of analysis that is produced by the Commission when it comes to launching excessive deficit procedure in the past, or to withdrawing this, terminating this excessive deficit procedure, the amount of analysis is very substantial, and it is much more easier for the stakeholders to see the reasoning behind. And I think there shouldn't be kind of many obstacles to arrive at a similar situation in the field of financial sector, which is for the time being not the case.
I'll come back to some issues of procedure. You mentioned that some of your findings is that some of the procedures are a bit lengthy, and sometimes the publication is delayed, and as you just told us, for reasons that are not entirely due to the Commission. Can you give us a little bit more color on that? How much can the length of the process be compressed? And also, what reasons delay publication of decisions if they're not internal to the Commission?
Well, yes, I think first of all, in the ideal world, we have a relatively quick decision. We have a quick publication, so that the public, the stakeholders are fully informed, also the competitors. So, and in many cases, it does happen. Yeah? In some cases, we observed several things. First of all, so-called pre-notification contacts. Pre-notification contacts happen before submission of an official notification, and it may last for too long. And during this period, actually, no one knows that these contacts are taking place. So in a way, there is a lack of transparency, lack of information for the potential interested parties. And this is especially important because the bar for any interested party, except member states and parties directly involved, to to redress eventually the decision is very high. Is very high. So therefore, the weaker the markets know about potential notification, the better. Yeah. Then basically what is that it's okay. These can take longer because the cases sometimes are very, very complex. Simply, what we found that some of these contacts were not taking place on the basis of a draft notification, and this, I think, something that we would like to limit in the future. Regarding publication, on publication, when the decision is adopted, the Commission always asks member states to inform, what parts of the decision should not be published because of confidentiality reasons and so on. And again, here sometimes member states do not reply on time. Sometimes it takes simply too much time for them to reply. Sometimes they don't reply at all, and then the Commission, in any case, publishes the decision because it can't wait any longer. But what we also observed is that that a full decision is never published. So again, here we looked at this publication procedure from the point of view of transparency and the right, the right to public scrutiny that are for the Court of Auditors, very important criteria. And I may fully understand that from the perspective of some other stakeholders, these are not the most important. Yeah.
So, sorry to display my ignorance here, but could the Commission cut that process short? Is the consultation of member states something, a constraint that it imposed upon itself, or is it something that is enshrined in rules that are beyond the Commission's reach?
No. On the consultation, I think, if I'm not mistaken, yeah, this the pre-notification contacts, they're normally according to the internal rules, I think 2 months. Then, as a result of consultations with member states, the Commission extended them to 6 months as part of the best practice code that I mentioned. So now it's 6 months. We observe that sometimes these pre-notification contacts go even beyond this.
But my question was for the publication of decisions.
For the publication.
Yeah.
Publication. Well, for the publication, it should be published in 15 days, I think, from the moment of adoption. Sometimes it takes longer, simply. And I think we mentioned also in the report that some decisions were published much later. So I think again this.
But I just want to understand whether this non-compliance by the Commission with the 15-day rule is to blame on the Commission, or whether it's not to blame on the Commission, and I'm a bit unclear.
it is not always to blame on the Commission. Not always, as I said, not always. Sometimes member states take too much time to reply. Sometimes they don't reply in months.
But if the member state don't reply on time, can the Commission just publish?
Yeah. We found cases that the Commission published. So this is, as I said, one of the positive conclusions. The Commission published still because of simply the need to publish. But again, I mean, the Commission did not publish a full decision. For the court, from the court perspective, we would welcome as full a decision publication as possible.
But basically, sorry to press you on this, but this is actually really important for people who focus on these things. Is there any possible justification for the Commission not to publish a full decision when it could?
Yes, basically, there is a set of criteria or a set of information that can be considered as a business secret, and we actually quote them in the report. So this information, for this information, the Commission can justify not publishing in full. We in our work, we saw that sometimes the information was not published, even though it could have been published, given that it was not exactly a business secret in line with the Commission's rules. So
right.
This is where I said that the Commission sometimes, yes, on the positive side, they have pressed member states, sometimes very tough. They also, in the absence of the reply, they did publish, but in our case, they in some cases could have cut less information than they did. Yeah. That's the bottom line.
So there are a number of questions on Slido about the rules themselves, and especially the temporary framework in March and how it affects burden sharing in cases of precautionary recapitalization. And I think we already addressed this. I mean, the paragraph 7 of the temporary framework basically exempts precautionary recapitalization from burden sharing requirement. ELA is exempt anyway, because that's in the banking communication from the start. And by contrast, when it's SRB resolution, or more generally resolution under BRRD, the bail-in criteria of BRRD apply, because at least if a resolution fund is to be used. So I think that addresses the questions that were asked in that department, unless Mihail, you want to comment further on that, right?
No, I think, yeah, I think you're right. I mean, we addressed this question, all the more that we did not look at the temporary framework. Or I mean, yeah, and that work might be done in the future, but obviously now it's too early. We're in the midst of
there's a question by the prolific anonymous questioner who says it's not really a question. He or she writes, I infer the answer confirms that a potential Cox-style operation is theoretically possible under the temporary framework, and my understanding is that this is a correct inference in the context of COVID-19. We have a question from Jan on the overall architecture of the banking union, and the way Jan asked that is SDG-COM sufficiently involved to ensure that we won't see the same discrepancies again. I'm tempted to expand this question and to say, well, as you know, there are ongoing discussions under the German presidency about completing the banking union. Actually, the German Minister of Finance produced a paper a year ago about their thinking about it. This discussion has not come to conclusion yet. Do you have any advice, not just for DG-COM, but for the legislators in charge of this debate on how to complete the banking union, on the basis of your findings on how the future revision to BRD to the SRM legislation, possibly to the supervisory framework. The whole debate about whether additional frameworks or regimes are needed for managing bank failure or whether it should remain broadly within the context of BRD resolution. The debate that the SRB has raised on whether resolution is for the few, not the many, or as a French official said at a roundtable earlier this year, resolution should be for the many, not for the few. He authorized me to quote him. So there are many debates on how this whole toolkit of resolution defined by BRD is playing out and whether it's going according to plan. Do you have any advice on this?
Well, yeah, it's a very broad question. I think at the risk of going a little bit beyond the report itself, I might say that we feel that there is a bit of a tension between the objective of the treaty, which is very clear in Article 107, general prohibition of the treaty, but under condition of the serious disturbance to the economy, it may be allowed, and a concern that appeared after the financial crisis about the financial stability. And this tension is still there. The good thing is that in the meantime, the EU has created quite a few institutions, several institutions with very clear responsibilities in all this chain. And I think it's very important that each institution kind of exercises their function in the current setup, and maybe it would be worthwhile to think in the future really how to minimize this tension between competition concerns, internal market concerns, and financial stability concerns that, as we see, very often boil down not to the level of the EU itself, and not even to the level of member state, but to the level of a region, or local area, and that's a bit of a contradiction in at least in my personal view that needs to be addressed.
So on the specific debate of the scope of BRD resolution, which is a big part of the current debate, did your investigation lead to any particular insights? And I fully understand that this is about policy making and not just the kind of controls that the European Court of Auditors does. But as I said, there is this controversy whether resolution should be for the few or for the many, to use the terms that have been now adopted in the debate. And the Single Resolution Board has put the bar very high by making negative public interest assessments in the case of the two Veneto banks in 2017, which is pretty central to the whole sequence. So do you have any insights from your consultations and research on this big current debate?
Well, I think on this point, again, from the perspective of the court, looking at upholding the principles of the treaty, looking at the EU taxpayers' money, looking at the achievement of the objectives that the EU has put forward since the financial crisis, it's very, and in the context of this BRD debate, it seems to be very important to ensure that the main principle of BRD about protection of the taxpayers' money is actually there and implemented in practice, and it would include a principle that if we talk about precautionary measures, they should be available to basically to the solvent institutions. Yeah, solvent institutions is a key principle I think that should be there. Yeah, I think I would stop here, because then otherwise I would go too much into what we did not do actually.
And one thing you did not do is express a particular assessment of individual cases. And since our last sentence could be read as referring specifically to Monte dei Paschi, I can understand why you're reluctant to go into more specification.
Well, yes, we have a sample of cases, very diverse samples. We have different types of decisions, different timing, but we looked at these cases not to assess the merits of each and every individual case, but to look at the system and how the Commission approaches case handling in general. So as we repeat many times, and I also repeat every time I'm presenting this in the public, we did not perform any legal assessment of any particular case. This is very important to avoid any misunderstanding here.
That's right. This is not judicial review. That's the business of other institutions, but this is to increase future performance and effectiveness. Right?
Yes, absolutely.
Okay, we promised that we would stop after 45 minutes, so we need to stop now, even so I personally would have plenty more questions. But it's a very important topic. It's an important report on a running theme. Thank you very much, Mihail, for having been with us. I hope you will continue to devote a lot of attention to this matter of state aid in banking, because I suspect it's not going to disappear.
Thank you. Well, yeah, we'll see. I would say auditing state aid control is not easy because everybody likes state aid. So, and this makes the work of the Court of Auditors sometimes very difficult on that front. But I think we managed to find the right balance, and we are really happy with the way how the Commission cooperated, and that they agreed to look into the system a bit deeper.
Everybody loves state aid, those who receive it, those who give it, maybe not those who pay for it, and that's the rest of us. And thanks for working on our behalf. Thanks very much, Mihail Kozlovs, and I look forward to our next discussions